Yeah, so I do think the Bank of Japan is underselling or underestimating the strength in underlying inflations. Keep in mind, since last year, their narrative has been that what we're seeing right now is import-driven inflation pickups concentrated in imported goods like energy and food, and that reflecting the peaking out of commodity prices, the prices are going to start coming down in the second half of the year and actually dip back below 2%. But I do think they are probably conservative in their inflation forecast. But our view is that the inflation is going to be prove much more persistent than the Bank of Japan and even the consensus expects. It is true that goods inflation will likely slow into year end and next year, but we have had acceleration and broadening of inflation pressures into services. So we actually think that the ex-energy core CPI could actually stick around 3%, at least for fiscal 23, and come down only slowly in 24. I think Bank of Japan, I have to say, though, that there's another element of this, which is that the Bank of Japan is perhaps, being overly and purposefully conservative in their inflation forecast because they don't want a situation where markets, anticipate a monetary policy normalization, which causes inflation expectations to fall and the yen to appreciate. That would cut short this virtuous cycle from price hikes to wages, back to spending that they're looking for. So I think they're, being dovish on purpose in a way to ensure that this inflation pickup sticks and that they don't cut that cycle short.
And that's exactly kind of what I wanted to ask you, what their game was here, because at the same time, you would imagine, a lot of people are suggesting that, even coming on our programming, that, the yen's going to be 120 by year end for certain, you're going to see that. But barring any kind of tweaking to YCC and barring any kind of currency intervention, with the prevailing macro conditions, how is that possible? Or is that possible?
Yeah, we actually have been pretty consistent in non-consensus and arguing from the start of the year that despite the strong consensus expectations of yen appreciation this year, that it wasn't really going to happen. And our thesis was twofold. One is that expectations of a significantly stronger yen are in some ways contingent on a sharp deterioration in the U.S. economy, which would provoke pretty big Fed cuts. And we just didn't think that was going to happen. On the Japan side, an important point to remember is that even if the BoJ adjusts YCC, or even in the risk scenario ends negative rate policy, like let's say this year, we're still talking about a pretty incremental move away from easy monetary policy. Compared to the Fed, which has short-term interest rates right now at 5%, the rest of the world, Japanese monetary policy is still incredibly easy. So one of our arguments is that we actually think that an early adjustment to YCC could in fact actually encourage the dollar yen trade because people will look at that and say, well, is this all you got? You're probably not going to move for a while after that move. So we remain yen bears, both short term and on a structural basis. And while we do expect a little bit of appreciation into year end and next year, we don't expect a return to 120 levels anytime soon.